Hi, Mike Elmale, recovering CPA, back with this next lesson in financial accounting, a mercifully brief introduction. After all adjustments are made, the final two columns of the trial balance can be used to prepare the balance sheet and income statement. GAAP also requires the preparation of two other financial statements, the statement of cash flows and the statement of owner's equity. The balance sheet follows the fundamental accounting equation, assets equal liabilities and equity. Here is joint ventures balance sheet. The balances shown are the amounts in the accounts at the end of the accounting period. Accountants are very particular about the format of financial statements. GAAP prefers a classified format, which classifies assets and liabilities as current or non-current. An asset is deemed current if it is likely to be converted to cash within 1 year. This usually includes accounts receivable and inventory. Assets not considered current are deemed non-current. Current assets are generally listed in order of liquidity. Liquidity just means the ability to be converted to cash. Liabilities are also classified as current or non-current. Current liabilities are those which are expected to be paid off within a year. All other liabilities are classified as non-current. The second fundamental financial statement is the income statement. The income statement shows the revenue and expense account balances at the end of an accounting period. They reflect income and expenses over the entire accounting period. Here's joint ventures income statement. If revenue exceeds expenses, a business has net income or profit. If expenses exceed revenue, the business shows a loss. The form of the income statement is usually dictated by the nature of the business. A simple service business income statement usually is divided into two sections, one for income and one for expenses. Retail and wholesale businesses usually show sales, cost of goods sold, and gross profit together with other expenses shown separately. Manufacturing companies follow a similar format but may separate marketing from general and administrative expenses. The next required financial statement is the statement of cash flows. Why do we need this statement? Many businesses use accrual accounting to reflect a reasonably complete picture of their economic performance over the accounting period. Nonetheless, at some point, all accrual assets and liabilities must be reduced to cash. Assets that could not be converted into cash would have limited value. A firm's ability to convert assets to cash is critical to its long-term survival. Because of the importance of cash flow, GAAP requires that companies prepare a financial statement that shows cash flows for the accounting period. Here's joint ventures statement of cash flow. The statement divides cash flows into three components: cash flows from operations, cash flows from investing activities, and cash flows from financing activities. Operating activities are the ordinary buying and selling activity of a business. Investing activities comprise the purchase and retirement of fixed assets as well as investments in other businesses. Financing activities are cash flows derived from the issuance and repayment of long-term debt and cash flow from equity contribution and draws to owners. These cash flow categories are used so that users of financial statements do not draw false conclusions about a business simply because the net cash flow increased or decreased during the accounting period. A business always seeks a positive cash flow, particularly from operating activities. However, short-term negative cash flow from operating activities do not necessarily mean that a business is unhealthy. In fact, during periods of rapid expansion, it is not uncommon for companies to experience negative cash flow because as credit sales increase, so do accounts receivable. Similarly, economic growth often is accompanied by increases in inventory, which also uses up cash. For these reasons, a user of financial statements must be careful not to jump to conclusions about the meaning of positive or negative cash flow. The last required statement is the statement of owner's equity. The income statement represents changes in an owner's equity derived from selling and buying activities of the businesses. But changes in owner's equity may also reflect cash contributions from and distributions to the owners. The statement of owner's equity reflects a summary of all components of the changes in owner's equity during the year. Here's the statement of owner's equity for joint ventures. Click here for the next lesson.